Good morning, good afternoon, wherever you're joining us from in the world, and thank you for joining us today. My name is Dion Che, and I earned my MBA from the Simon School back in 1998. I also happen to work at Bank of America, where I am a business strategy and initiatives manager focused on enterprise payments. I'm also a member of our university's alumni board, and that's a group made up of 25 members who represent all of the different schools at the university. And our purpose is really to make sure that we are engaging all alumni and students in a lifelong connection with one another and with the university. So I'm really thrilled to be here today to provide the opening remarks for today's session, which is part of our Experience Rochester series. We launched the series back in April of 2020, and the series really exemplifies our commitment to lifelong learning. The series features topics and speakers that are unique to the University of Rochester. And today we have two of our best. We're going to be joined by Simon Dean, Shevin Yeltikin, as well as Senior Associate Dean Jim Brickley. And they're going to be discussing crypto markets, FTX's corporate governance flaws, as well as the lessons that can be learned from the collapse that you might have heard about in the news. Our presenters today have really remarkable background for this topic, but it's worth going over a few bullets related to that. So Shevin Yeltikin, who's the 8th Dean of the Simon Business School, is also our Frontier Communications and Rochester Telephone Professor of Business Administration and Economics. And before she joined the University of Rochester back in 2020, she was a professor of economics at Carnegie Mellon's Tepper School of Business for about 15 years. During that time, she really cemented her reputation as a highly respected macroeconomics scholar, and she's well known for her research in things such as fiscal policy design, social insurance design, computational economics, as well as asset pricing implications of macro policy. We also have Jim Brickley, who is our Gleason Professor of Business Administration and the Senior Associate Dean of Faculty and Research at the Simon Business School. Over his career, Jim has published numerous papers in many high-quality journals related to finance, accounting, law, and economics. His early work focused on corporate dividend policy and franchising, but lately he's been more focused on agency-related and corporate governance issues. In fact, he's served as an expert in many of those high-profile corporate governance cases. And then when I was at the Simon School, Jim was actually one of my professors. So I'm really pleased that I get to introduce him here today. All right, so at the end of the session, our panelists, after they give their remarks and have a discussion, they're going to answer as many questions as they can from the audience that time will allow. Please go ahead and put your questions into that Q&A box that you see at the bottom of the screen. You can put those questions in at any time. So again, thanks to all of you who joined us today. And now what I'm going to do is I'm going to hand it over to Dean Yeltikin. Shevin, the floor is yours.
Thank you very much, Dion, and welcome everybody. Good morning, good afternoon, good evening. I know that you're joining us from a whole variety of different locations. So the way that this is going to work is that I am going to talk very briefly about kind of crypto markets and blockchain, and then hand it over to Jim to talk about FTX in particular and talk about especially the governance issues. And then we'll take questions from the floor and have a Q&A session. And as Dion has said, at any point in time, please put your questions into the Q&A and we will answer them in the order that we receive them. Okay, so this is a headline from Wall Street Journal, February 3rd, a couple of months after FTX's collapse. And in one of the headlines about the FTX, a quotation from the manager, asset manager and CoinShare says, "I don't think FTX would freak out in the slightest anyone who understands the fundamental investment case of Bitcoin." Fundamental investment case of Bitcoin. So let's look at what's been happening to Bitcoin. You don't have to really be a finance professor to see that, this kind of fluctuation and lack of sort of any discernible kind of appreciation in the asset over time as a trend does not really make this a very good investment vehicle. But Bitcoin is interesting. I don't want to dismiss it offhand. So I want to talk a little bit about sort of where we are and what we know about kind of the crypto markets. So the crypto markets or cryptocurrencies were really, introduced first to present an alternative financial system. What is really a financial system? A financial system is really a series of databases. If you just even look at the traditional financial system, where's my money? I have some cash at the bank. I have a deposit account at the bank. And that's really a ledger balance. And then if I write you a check or if I transfer some money over to you, make a payment to my credit card company or for my rent, that's really one entry from one database to another entry in another database. And banks are not the only places where these databases are used. When you think about all of the assets and different kinds of assets that we own, whether that's our deposit accounts, whether that's our brokerage account, whether that's your house, where the title company would have a database, or your car, where the DMV in your state would have a database of who owns what, and titles change hands. So what do? We basically keep ownership and balance of these assets and in these deposits in databases. And when we make transactions, we have trusted third parties verify those transactions. So when I go and put in my Amex card at CVS to buy some things, to buy some over-the-counter Advil, then obviously the trusted party, which will be my bank as well as Amex, will do the clearance of that particular account. What about we replace that trusted parties with a database held by everyone? Because most trusted parties, quote unquote, are trustworthy, but there are some that have been untrustworthy. We've had some really bad sort of cases of investment banks or brokerage accounts or funds that have gone belly up, and we found out that they didn't really protect the deposits of their investors. So what if we just distribute that? That's great. So now everybody, every single one of us, if we want to hold these databases, but we have to have a coordination mechanism so that when I make a transfer to Jim or Dion, not only I put it into my database, but Dion will put it into his database too. But that's not enough, because he and I can have a dispute. I could say, I paid you those $5, and he could come up next day and say, that's not what I'm seeing in my entry. You didn't pay me those $5. So instead, we're going to actually establish a system where these transactions are going to be secured. They're going to be secured in a way that not only it's not going to reveal a lot about the transaction, but it's also going to be really difficult for either Dion or me or anybody else for that matter to change and alter that transaction. And we're going to keep this transaction on what's called on a blockchain. That's where really great involvement of distributed systems, databases, meets and marries cryptography, because we want to do this in a way that is going to be secure. So that's quite a clever way to do this. Here we are. I put a message into, there are many ways to use cryptography. There are different kind of ciphers out there, things that have been used during world wars all the way to the very sophisticated cipher systems that we have now. And I put a particular message into a 256 hash cipher, and out popped this. Anybody want to wager a guess what this one might be? What does this say? It's impossible, right? It's a collection of numbers and letters, and it's really difficult to make any sense of it. And even if you had incredible computing power and an infinite life, it would be pretty impossible for you to decipher this particular message. We're University of Rochester. What did I write into there? It's actually Meliora using the 256 hash, right? So we're going to kind of do the transactions in a way that's secure. The way to think about it is that it's easy to verify the transaction without revealing too much of the information inside it. So it's easy to go one way. I can put in Meliora and out pops this sort of intricate, string of numbers and letters, but it's really difficult for you to undo it. If you want a more common way to think about it, you stir your cream into the coffee, really easy to do. Most of us do it multiple times a day, really hard to undo. If you all of a sudden you realize that you want to actually have black coffee, you'd have to go get another cup of coffee. So that's the way that the cryptography is going to work. So the crypto, the main kind of technology behind the crypto financial system, especially Bitcoin, when it was first introduced with the blockchain technology, is really a fascinating combination of game theory, incentives, cryptography, information system. And the idea is to replace trust so that we don't have to have these third parties, banks and brokerage houses and credit card companies and so on to verify these transactions. We can do this collectively. Although having a few people hold databases versus having lots of people hold databases, that's not as efficient. So there is a cost associated with it. And at the same time, though, what is it in me? Okay, maybe I want to hold the database that transacts, keeps the transactions of what I paid somebody and what they owe me. But why do I want to know the transactions between, let's say, Jim and Dion? Why do I want to know the transactions between any of you in the audience? That seems like a huge waste of my time to want to keep your transactions in a database that I manage. Well, I do that because I get incentives to do it. And that's where another very interesting part of this technology is that it's actually incentive scheme is baked into it. But that's not enough because we're talking about currency. Currency cannot be replicated. Look, this digital file, you're seeing it on here. You can take a screenshot of it. This is being recorded, and you can replicate this almost costlessly, many, many times over. You can write Meliora many, many times over. If an asset or a transaction or a coin is simply that string, then we can sort of costlessly replicate it. And then we have abundance, then we have inflation, then we have no value attached to that coin or that asset. So we're going to also have to create a digital scarcity. This is an incredible coordination game. So this part of the crypto market, this part of the technology is fascinating and can have some applications. But at the same time, the crypto market has provided new or what I would call bad solutions to what traditional finance figured out, honestly, decades, if not centuries ago. Anybody who's taken a history of banking or a money and banking class would see exactly how money works and how we've used it from grains to other things to do transactions in. It's also reinvented and rediscovered what finance has been doing for centuries. So there's some lessons to be learned from the wrong missteps, but there's also some lessons to be learned from the technology itself. But crypto as a financial system, not so great, especially as a currency system. Why? What's the purpose of a currency, right? Anything can be a currency. We can do tennis shoes. We can do grains. We can do leaves, from fall leaves that have fallen onto your yard. But a currency needs to make transactions efficient. It needs to be a medium of exchange that we all agree on. In other words, if you want to pay me in dry leaves, I need to be willing to accept them. It needs to be a unit of account. It needs to measure the market value of activities, right? If I tell you this particular jacket costs 4 dry leaves, what does that mean? What is the market value of that? It needs to be divisible and stable. It needs to be a store of value. I talked about the fact that grains were used as money. Well, they turn out to be not great because if it rained or a rat got into the grain hut, then we would have a huge amount of waste going on. So it does not get destroyed and it's ownable. It has my name on it. My deposit account at the bank has my name on it, right? And cash, the fiat money that we have, it's great because it replaces all of the trust that we need. One benefit of having cash rather than a deposit account is that we don't need the history of transactions written on my dollar bill. I'm the bearer of the dollar bill. That's all you need to know. And you need to be able to accept it. So cash, credit cards, deposit accounts, all of this part of a monetary or currency system. Bank accounts offer lots of benefits. They do ease of transactions. We get debit card, credit cards, wiring, Zelle, you name it. It also has safety. We have deposit protection, and it's a regulated industry. It facilitates lending, investment, and growth in the economy. The banking sector is very important in facilitating that intermediation. Most importantly, it's convertible. I can take my checking account, and if it says $1,000 is in my checking account, I don't worry about, oh, am I going to be able to convert this to dollars? It's already in dollars. It's already convertible into a liquid form. Provision of liquidity by central banks or the Federal Reserve in the United States. These are national currencies backed by governments. Now, some people don't like that. They say, oh, we don't want a government. We don't want this sort of monolithic entity that we don't really know their true preferences or true motives to be running currency. We want to decentralize and democratize finance. But they do a very good job, most of them, of ensuring the supply of currency. That means managing its stability, convertibility, reliability, scalability, and scarcity. But they manage something else as well. They manage the devaluation of the currency. Why do we have a target rate of 2% inflation? Why not? Why is it not zero? Why is it even negative? Why don't we want prices to fall? We don't, because we want you to dispense with your cash. We want you to earn good money. We want you to spend good money, because that's what's going to make economic activity continue. So Bitcoin and other cryptocurrencies, is it really decentralized or democratic? These are mined by large facilities with unidentified monopoly or cartel owners, because the amount of energy cost that goes into mining a Bitcoin is massive. It is more than getting one Bitcoin is more than sort of, national energy consumptions of some small countries. Convertibility, stability, deposits, none of that is ensured. It's not scalable. It's not a great unit of account, because we don't really measure market value in Bitcoin very easily. It's not a great mechanism of exchange either. It's not widely traded. And it's not a great store of value, if you remember the graph that I showed you at the beginning. And Bitcoin appreciates mainly because the supply is capped. It's written into the code to cap that supply. People want to hoard it rather than use or spend it. We don't want currency to be like that. We want people to spend their currency. And what do you really own? What is ownable? What is your digital wallet secure? And we've had a lot of hacking incidents. Can you make money in these markets? Of course you can. Sure, with tons of risk. But I also want to point out that people have thought about it as an inflation hedge, as an uncorrelated asset, as a great stock market hedge. It just didn't pan out that way either. So they're not inflation or stock market hedges either. Okay, so that's my sort of introduction to kind of crypto. Like I said, I believe and I'm fascinated by the technology behind it, especially how it brings different disciplines together to solve some interesting problems in a financial system and a monetary system. And we'll now leave it to Jim to talk to you about especially FTX's problems, and we'll come back for a Q&A. Jim, over to you.
Okay, thank you. Let me just share my screen here. All right. Well, thank you, Shabin. That was, very interesting. So I want to talk about FTX and its collapse and its implications. Its sudden collapse in November of last year sent literally shockwaves around the world. It's been in the press a lot. People have asked the question, how could this happen? What are the implications? And I think it does raise a lot of interesting questions related to corporate governance, investor behavior, and other things. So many of you, I'm sure you've seen Samuel Bankman-Fried, or as he's affectionately known, SBF, commonly known in the press. But let me go through some of the details, timeline, just so we're all on the same page. So SBF founded FTX Trading Limited in 2019. At one point, it was the third largest cryptocurrency exchange in the world, had millions of users. SBF was touted here as perhaps by Fortune here, the next Warren Buffett. He was ranked as the 41st richest American by Forbes magazine. At one point, his estimated net worth was 17.2 billion. I might say it's less than that now. One interesting thing is that some really noted venture capitalist funds, institutional investors, and wealthy individuals invested in this company, buying their stock, preferred stock, totaling about $2 billion in investments. Some of the noted investors, Sequoia Capital, which is noted for its investments in Apple and Airbnb and others, SoftBank, Tiger, I got quick on the thing here. Sorry about that. And some pension funds like Ontario Teachers Pension Fund invested between $100 and $200 million in it as well. Customers deposited, meanwhile, billions of dollars in trading accounts. So they'd have money in these trading accounts and then they can buy and exchange. It would either be a fiat currency or it would be, like Bitcoins or some other one of the cryptocurrencies. In November of last year, FTX filed for bankruptcy. The Department of Justice subsequently indicted SBF on 8 counts of fraud. The SEC also filed a civil suit against him. The major claim that was made was, or one of the major claims is, FTX had these billions of dollars in these trading accounts. Allegedly, the claim is that SBF told people, and in fact, it was in their service agreements, that these are safe and secure, where allegedly they were being transferred out of these accounts into a subsidiary that SBF also had the controlling interest in and being used for risky trading, keeping another unit solvent, personal uses, and so on. So we'll see how those claims trials turn out here in the future. So the end result is that many investors are expected to lose their entire investments. In fact, Sequoia and others have written these down to zero, essentially. And many of FTX's customers are not expected to receive the full value of their deposits. And indeed, even if they do, it's going to take a while to go through these bankruptcy proceedings. And these prominent investors I mentioned have certainly taken a reputational hit. Ontario Teachers Pension Fund, being on the front page of the Toronto Globe or whatever. Regulators have looked at, both in the US and in Canada, at some of these investors, wondering if they did the proper due diligence, complied with laws, and so on. So one of the things that you might have noted, and certainly has been a claim, is FTX represents a failure, a massive failure in corporate governance. So you might ask, what is corporate governance? Well, one way to think about a corporation, and a common way to think about it, is their separation of ownership and control. You have external investors putting money in to finance corporations, and they're run by insiders who may be self-interested. And so you can think of corporate governance broadly as the ways that corporations help to ensure that the capital they get is wisely managed, and to assure investors that they'll get a return on their investment. Prominent elements of the corporate governance system include things like the regulatory environment that the firm operates in, the board of directors, which is there to monitor the executives to ratify major decisions, outside watchdogs like the auditors, for example, and importantly, the internal controls and processes within the firm. Now, John J. Ray has been involved in the restructuring of Enron and others, massive examples of scandals and failures and so on. And in the bankruptcy filing, he's the new FTX CEO that's in charge of handling the restructuring. This is a quote that's received a lot of attention. He says, "I've over 40 years of legal and restructuring experience." And then he goes on, "Never in my career have I seen such a complete failure of corporate controls and such a complete absence of trustworthy financial information as occurred here." So what's he talking about? Well, I don't have time to go into all of the details here, but I'll give you a flavor for some of their governance problems. So the regulatory environment. The main FTX is headquartered in the Bahamas. The Bahamas has touted itself as being the new center of the crypto world or crypto space. They were early in adopting a regulatory regime and laws related to cryptocurrency. The government has held conferences to try to attract crypto firms. And it's informed speculators have suggested that one reason that FTX may have located its main operations in the Bahamas rather than the US or somewhere else is that even though Bahamas have these laws and regulations, they may not implement them and they may not enforce them very in great detail. It was a great coup for them to get the third largest cryptocurrency exchange to locate there and fit into their governmental strategy. And it's reasonable that FTX might have expected to have some favorable treatment. So the regulatory environment has been questioned. Now, in the typical firm, the board of directors plays a major part of the corporate control system. If you look at publicly traded companies, a majority of the board are outside directors with various expertise. If you look at a startup company, you generally often see the venture capitalists who put up their money to being on the board and overseeing the management of the company. Now, FTX's board is much different than that. Their main board of directors consisted of two people, SBF and an attorney from Antigua, where FTX is, the main FTX is chartered. On FTX's or on their website, the attorney is noted as being an expert gamer. So you have these two people on the board of directors. It's not clear how frequently they met, and then, there's no comprehensive set of minutes or records that you might expect to see. Now, one of the things that the board of directors normally do is they're responsible for approving related party transactions. And FTX had a lot of them. In fact, at the end of 2021, the largest asset on their so-called audited financial statements was a related party receivable of $1.2 billion. Presumably, if they were approved by the board of directors, they were basically approved by SBF himself. In terms of problems with the internal control system, there were many. In terms of cash controls, they didn't keep a complete record of their bank accounts. Like the bankruptcy examiner or the new CEO has had a hard time identifying where money is and who was able to sign on these accounts. In fact, at the time of the bankruptcy filing, they didn't know how much cash FTX collectively had. Disbursement controls. You've all, I'm sure, have expense reports and receipts you turn into your companies, and the process is used. At FTX, this was done through some sort of chat app, and then the people that would approve it, and there were various people throughout the organization that did this, they would send little smiley emojis or whatever. Another thing that was a real problem was any cash and resources went out of the firm to buy property and other things that were sometimes registered in the executives' names, were not recorded as loans, and so their disbursement controls there were very bad. In terms of corporate books and records, SBF would do a lot of things using some app that would self-delete things within a short period of time, and he encouraged employees to do the same thing. And so there's not a set of corporate records. The security controls allegedly were even written in ways where they could get around certain regulations and so on. And so they allegedly had poor security controls, and they didn't even have a good record of their employees. They sort of mixed outside contractors with their own employees. And at the time of the filing, they weren't sure who was employed by FTX or not. The corporate structure itself is very complex. It's like there was like 100 affiliated companies, pretty much all of them owned largely by SBF. And there was all sorts of potential conflicts of interest and ways of manipulating things through this corporate structure. The financial statements, they did have the two of their major units audited, and they purported to have financial statements. These aren't public because it's not a publicly traded firm, but they would give them to their investors. However, the auditors were these two smaller firms that specialized in cryptocurrency audits and seemed to act more as cheerleaders than skeptical auditors, like they tweet things saying, oh, this company's good and all this sort of stuff. And the bankruptcy examiner has basically stated that these financial statements, you can't put any reliance on them whatsoever. That said, they did suggest certain red flags, like these large related party transactions and so on, that you would think would draw some investor concern. So a question arises, why would these sophisticated investors like Sequoia invest billions of dollars collectively in FTX, as well as, if I had time, I'd go in and talk similarly about WeWork, for example, and perhaps Theranos, in these companies with inexperienced management and somewhat obvious corporate governance problems. One response that's been given by some of these investors is, well, wait a second, we're in the business of taking risky bets. Some of them aren't going to work out. These are small amounts, proportions of our overall portfolio. This is just to be expected. A lot of informed observers say, wait a second, that you've got people like here, SBF, that have limited management experience. You see the board of directors, you see these financial statements with these large, related party transactions, come on. Some observers, and I think there's some truth in this, have suggested that there's this tendency sometimes to get sort of falling in love with the founder. I mean, here's this guy wearing shorts. He plays video games sometimes during finance pitches. He's a MIT graduate with a physics degree. He knows about cryptocurrency. His parents are Stanford law professors. Yeah, why not? He must be a good bet. Invest in the company. And I think to some degree, you saw the same thing with Theranos, Elizabeth Holmes, Adam Newman, for example, at WeWork. Another thing is these companies these funds don't want to miss out on the next best thing. If cryptocurrency is that, well, geez, we see our other competitors investing in this, we want to do it too. Now, this joke is from 1999, but I think it fits pretty well with what some people view, this investment behavior to be like today. Here are these two venture capitalists coming in. Wally, we're venture capitalists. We want to invest in your web-based business. I don't own a web-based business. I'm just an engineer with a cool ponytail. Oh, that's good enough for us. We want to get in early. So this is just a quote from the Wall Street Journal. It basically talks about how these Sequoia and these other Silicon Valley firms broadened away from their traditional model where they would demand board seats, put up money, and instead, took more daring bets. Now, at least one of these companies, I think, has purportedly learned from this experience, because they were raked over the coals to some degree by the press and investors. They took the very rare move of apologizing to their fund investors, and they promised to do better due diligence in the future, including asking for financial statements, even for early startups, by one of the large Big Four accounting firms. So what are some lessons to learn that you might take home from this? Well, the first thing I would suggest is that investors should learn to be careful not to invest, or at least go in with their eyes wide open when they invest in companies with poor governance and controls. Now, sometimes that might consist of firms with questionable boards of directors, other things that you would observe. But it goes beyond this. If I were to talk more broadly, I could talk about state-owned enterprises from China. They don't give much protection to minority investors. The variable interest entities, another thing I could go into. There are certain Chinese companies, Alibaba being one, that's organized in that way. Firms with unusual voting rights, different dual class shares. Now, I want to emphasize that some of these firms might be good investments, and there are some reasons why you might have dual class shares, at least at the start of a company. But I do think there's a reason why firms, historically, the successful ones, have had good internal control processes, good board of directors, and basically good corporate governance. And investors should not naively go in and invest without their eyes being wide open. If you're one of these venture capitalists, I wouldn't want to rely on just saying, oh, this is a small portion of my portfolio, losing a couple $100 million. They have, like this in this example, been raked over the coals to some degree by the press and others. Regulators have taken a more careful look at them. So I think, as Sequoia concluded, proper due diligence is important. Lastly, if you're a small investor or customer, you may not be that sophisticated, but I would not blindly follow the lead of the so-called sophisticated investors because they make mistakes. And I wouldn't put a lot of faith in ads, featuring Tom Brady, Steph Curry, and others promoting FTX. Again, you should go into things with your eyes wide open and understand the risks involved. So that's basically what I have to say. I will stop my screen share here.
Well, thank you very much, Jim. This was really interesting, and you and I have been discussing as we got ready for this webinar a variety of things, and reading lots of different newspaper articles and commentary, digging deep into our own expertise in whether it's corporate governance or macroeconomics and money and banking. So you've been involved in sort of, working with regulators. So one of the questions that's also in the Q&A, one of the questions that comes very sort of as a follow-up to the FTX debacle is, were the regulators asleep on the wheel? Why didn't they do something about this? There were lots of red flags that maybe Sequoia Capital should have known and SoftBank should have known, but so should the regulators. Starting with where they're registered all the way down to how they're, what was happening with the two entities, Alameda Research and FTX.
Well, I might mention that U.S. traders were not allowed to trade, on the main FTX exchange in the Bahamas. They had a subsidiary, FTX, the U.S., which was affiliated with the company. So there was, some separation of that. Now, there certainly is debate about whether the SEC or the Congress or other regulators should have adopted more stringent regulations, enforce them, and so on. So there's a debate about that. But I do think it's important to note that I think it's unrealistic to expect the SEC or regulators to be the frontline defense against fraud and misdeeds of companies. There are thousands of companies in the country that are somewhat under the auspices of the SEC. The SEC has a lot of other functions that they perform, and it's just unrealistic to think that they're going to be the ones that are doing the detailed audits and looking and detecting, what fraud going on in the operations. They can pass regulations and so on, but if people aren't complying, how are they going to know? Well, if you look at the scandals going back, to Enron, WorldCom, you look at more recent ones, Luckin Coffee from China or whatever, it's usually some other party that detects it first. Might be the auditors, internal whistleblowers are important. The media doing investigative reporting. For publicly traded companies, short sellers can be important, large investors, analysts. So generally, the corporate misdeeds are discovered by someone else, and then the Securities Exchange Commissioner, whoever it is, then gets into the act to try to investigate it, see if laws have been broken and so on. So in the case of FTX, for example, it was a report on Coinbase that basically questioned FTX's solvency, leverage, relationships with Alameda that got this thing going. And then now the SEC, of course, and the government is involved. So I think it's easy for, especially if you're in one political party and another political party is in control, you can say, what happened to the SEC? They were asleep. And maybe they were. I mean, I'm not a big fan of some of the stuff that they're doing, but I think it's unrealistic for you to think that they're going to protect investors. So going back to sort of my punchline, to a large degree, I think investors and customers need to protect themselves by assuring that proper corporate controls and internal controls and so on are implemented. Let me ask you a question.
But before we get there, then the lesson is that just because these sophisticated looking investors or venture capitalists who are investing in these companies, we shouldn't follow them blindly. I mean, what we're seeing is that two things. They've made some really bad bets in the past, like Theranos and WeWork and FTX. And to some extent, they can take that risk because it's a small percentage of their portfolio. But the individual investor, whether it's the meme stocks or even a somewhat sophisticated investor, can't really afford to take on those kinds of big bets as well. So take that signal very, very with a big, giant, fat grain of salt, I think is your message, correct?
That's certainly, yes, that's certainly one of them is just don't herd and follow parties that may, as you say, large venture capitalist funds. FTX losing a couple $100 million is a lot of money, but it's small relative to the billions of dollars that they manage. At the same time, they do have to worry about their reputation and so on. But the other thing that I'm emphasizing is that be prudent in not only not following, but also looking and saying, what companies you want to invest in. For example, investors, when WeWork tried to go public, one of the reasons they couldn't go public originally was investors did look more carefully and they said, hey, what's going on with this company and their voting rights, and stayed away from it. So people, to some degree, need to protect themselves.
Okay, that's very interesting. Yes, that's definitely one of the questions. We're going to come to the Q&A, but you had a question for me before we go to the Q&A here.
Yeah, one of the things that I'm interested in is, blockchain technology, and certainly that's an important part of the, of cryptocurrency. But there are other potential uses as well, as you allude to. Are there any particular underlying uses for blockchain technology that you're interested in?
Yes, I am actually, and I'm going to show you one particular one because I don't have time to rattle off a whole series of them. I mean, when you think about the technology itself, what it's doing is that it's sort of securely documenting and keeping records in a distributed ledger that is pretty impossible, almost impossible to undo or modify. And when you think about especially our world, right, our world of research, one of the things that a lot of scientists, whether they're social scientists, natural scientists, or engineers do is that we do a lot of, in our quest for knowledge, we also have a lot of sort of incremental work that we do. You run an experiment and you learn something from that experiment. You do a regression and you learn something from that regression. Before we get to the stage where we publish a paper, there's a lot of discovery going on, some that's usable, some that's not so usable, but you want to be able to, let's say, record those discoveries. You don't want to sort of let the cat out of the bag too quickly, because you don't want people to go, oh, that's an interesting regression, and go and take it and do something else with it before you have a chance to publish. You want to have some sort of claim rights over some of the step-by-step discoveries that you've made before you can publish that paper. So one of the places where I've actually been a founding member of, so I'm going to project it here so that people can see it. It's a scientific blockchain. It's the Association for the Advancement of Science and Blockchain. It's actually a consortium of many universities across the globe, and it's being operated by the Max Planck Society in Germany, which is, for those of you who might not know, it's like a NSF meets a private fund for in Germany, very well respected, and their digital library is the one that spearheaded this particular initiative. And I joined it really early on as a founder. The idea is that this is blockchains by science for science, meaning that we can actually record on the blockchain these discoveries, maybe share some data, because Jim might be able to run an experiment with a certain focus group in Rochester. I might be able to run a similar experiment in South Africa. Somebody else might be able to run a similar experiment in India, but sharing that information in a secure way is typically very, very difficult. In addition to that, there's lots of data regulations, especially if you involve human subjects. So the idea here is to actually use a kind of a blockchain for science by science, which are all the scientific entities over here, to be able to share this securely. Now, we have our own coin, or token rather than a coin, called a Berg. Now, the Berg is not traded, so don't get too excited. You can all open a faucet and get your Berg. We give it away for free. And you can write actually decentralized applications, DApps, or smart contracts. And we run it now on the Ethereum platform, but we welcome anybody who wants to tinker with it and wants to write some smart contracts. Other people have talked about supply chains. Other people have talked about sort of being able to trace that piece of steak that you bought to its original farm. There are lots of different ways that the blockchain technology can be used. I don't think we've seen a very massive scale and a very sort of extremely kind of, a large group of applications that have been adding value, because the first question you should always ask yourself is, does this need the whole infrastructure of blockchain, or can I do this on my Excel file? If the answer is you can do this on this Excel file because all you're doing is sharing information across your units in a company, you don't need the whole blockchain technology. It's costly. It's costly of time. It's costly of all of this verification. This computer that I'm speaking from is right now running a verifying node for that scientific blockchain as we're speaking, and it's using up a lot of my certainly computing power. But there are more and more apps coming online, anything from electricity grids to the ones that I have talked about. So I'm excited to watch to see what develops. Not as excited about the cryptocurrency market. So that's my answer. Okay, let's go to some of the Q&A on here. So there's lots of questions coming in, and there were some questions that were submitted ahead of time. So I'm going to do as much as we can in the 10 minutes or 8 minutes that we have left. One of the questions is that, FTX was based in the Bahamas. So that seems like maybe a bit of an obvious tip off. And how do we find out the origin of a company, where they're registered? Would be registered in the United States a good way to actually kind of do a very quick smell check? What do you think about that, Jim, from a regulatory?
Well, first of all, FTX is a very complex company with lots of different subsidiaries or affiliates or whatever. Okay, so the FTX in the Bahamas was not something that US investors could actually trade on. There was a FTX US, which would have been under US regulations and so on. The issue is that's being debated right now is, should there be more regulations and enforcement? For example, the SEC now is all of a sudden asking questions about whether stable coins or securities, and whether certain lending activities should be going on, and so on. And so, and FTX also had, like Japan, for instance, had a bad fallout in 2014 with a hacking scandal that cost people a lot of money, and they adopted a bunch of laws that would help to protect customer deposits. Their FTX, their subsidiary, as of yesterday or the day before, they're beginning to allow them to withdraw money back. There's some operational glitches, but they may indeed be solvent. In fact, in the U.S., it may be that the customers of FTX US are ultimately in better shape than those trading on some of their other platforms or whatever. But again, it's going to take a long time, I think, to sort this out.
Okay, so just keeping on that theme, because I'm seeing a few questions both previously submitted and also in the Q&A, is that, if we're talking about kind of the ordinary investor, right? For the ordinary investor, how would you propose that they assess risk? So we want to get into some, when I want to formulate what the risk profile of a company is, what would you propose that they do?
Well, one of the things that you would think about is there are companies like Coinbase and so on are coming out with audits of whether they have the proper reserves and safeguards and so on. And you can also, if you do your own reading on it, it's probably more dangerous to store your stuff in wallets that are over the internet versus wallets that are not. Coinbase has certain insurance, for example. So I think you can collect information on the status of whether indeed FTX claimed that the customer deposits were separated from everything else. But I think there are other ways of detecting, from third-party audits and so on, whether indeed that is the case. So, and there are, certainly there are watchdogs and so on that look into this sort of stuff and try to rate, like the equivalent of Consumer Reports, for example. So if I was frankly, I don't trade on any of these exchanges, but if I did, before I put my money or I started exchanging on one of these, I would go through and do that sort of due diligence, and you can do that fairly, quickly over the web and so on, I think.
Well, that's certainly true, and one of the lessons learned from this is that whether you look at these meme stocks, whether you look at the sophisticated investors, you still have to do your own due diligence, and there are resources available. And if something smells bad, it probably is bad. If it's something smells too good to be true, it probably is too good to be true. So those are just some very basic rules of thumbs that we can apply. And so as far as going forward now and regulation is concerned, Jim, should they be regulated, these crypto markets and cryptocurrencies?
Well, the devil is in the details, okay? The optimal amount of government regulation is not zero when it comes to financial markets. People feel a lot more secure trading, on stock exchanges and so on in the US than they would, at certain other places, or they do in certain other places of the world. I think what I observed in my long observation, however, of scandals and reactions to them is there seems to be, like you go back to the 2001 Enrons and so on, and all of a sudden, oh, geez, the regulators, Congress is being raked over the coals for not doing anything. Therefore, we'll pass a bunch of laws. Oftentimes they have unexpected consequences and so on. You saw the same thing after the 2007, 2008. So right now you see a lot of things happening. I do worry about an overreaction. It's going to be a rocky road, though. For example, a lot of the stuff's likely to end up in courts. For example, the SEC is arguing that these stable coins that are paid to the dollar or whatever are actually securities. That's a legal question. That's likely to end up in court. If it's not, then the question is, what regulatory body should be covering this? Is it the SEC? Is it the Commodity Futures Trading Commission? Is it the Federal Reserve Board? Is it the states? There's a lot of things to sort out here. I do worry that experience suggests that you can easily get overregulated, which is going to stifle innovation. It's going to hurt both customers and companies. So I'm leery of what is going on here, but as I said, the devil's in the details.
So one last question to you before I answer a couple of those that are more about on the blockchain and cryptocurrency is that, you know, when we actually think about sort of regulation, I mean, one of the ironies is that SBF himself was out in had a lot of political connections, was contributing to various political parties and actually lobbying for regulation of the crypto market. So do you have any thoughts about that? Is that just sort of posturing or?
Well, you know, obviously, it's good to be close to powerful politicians and regulators and so on. I do think, and I should have mentioned this, one of the things that's valuable about regulation is potentially for these firms is it reduces regulatory risk. One of the things that's really difficult right now for a company is they don't know what's going to be legal or not legal. You know, oh, geez, can I do this? Is it going to be ruled, you know, that I can't do these stable coins or I can't do, you know, staking or whatever it is. And so if you have a stable regulatory environment that's predictable, there's a value to that. So I could see where it would be in the interests of the, you know, the cryptocurrency industry to have a, you know, certain regulatory structure that they could rely on and find, you know, as being predictable.
That's great. So there's, I'm getting the message that we're almost at time, just with one question left. So I'm going to try the impossible task of putting together a few of the questions that were coming up on Bitcoin and cryptocurrencies in general, which is the piece that I presented. And a lot of the questions is about, you know, is this, if the mining is really costly, is this sustainable? The answer is no, it's not. That's why we've moved from proof of work, which is what the Bitcoin uses, to proof of stake or proof of authority. What's the difference between an Excel file and a blockchain? Excel file you can modify, a blockchain you cannot modify. That's why there's, how do we replace trust? We actually put together an incentive scheme that replaces trust. We don't try to form those relationships. You know, blockchain is owned by and verified by a list of complete strangers that you know nothing about. And that's kind of both the scary thing about it and the beauty of it, that we don't actually need to know the counterparties, but we've designed a system in a combination of technology and monetary system or an incentive system that replaces that trust. So there's lots of great things to dig into here. Hope to be able to spend more time with all of you about everything from corporate governance to crypto assets. Thank you for joining us.
Well, Jevin, Jim, thank you so much for the knowledge and information and insights that you've shared today. I tell you, I think about, Shevin, everything you shared with us about the incentives for even using cryptocurrency versus the case of FTX, where Jim went over many of the problems with their governance structure and even just the ability to measure what they're doing. And it's so clear to me that this is a classical example of those three legs of the stool just being completely unbalanced. So that stool is going to collapse anyway. That's my plug for Managerial Economics by Jim Brickley. Well, I want to end the session by saying thanks to all of you who joined us today, and thank you for all of the questions. I'm sorry if we couldn't get to all of them. I think we probably could have talked for another hour. We hope you enjoyed this program. We would love to hear your feedback. When you exit this Zoom call, a survey will pop up. Please fill out that survey. We're going to use that to improve and continue this series of Experience Rochester events. And by the way, our next event is going to be on April 20th at 12 noon. And that is going to be focused on, can't wait for this, considering the search for life in the universe with Dr. Adam Frank. He's a distinguished professor of physics and astronomy, and also a distinguished scientist at our LLE organization. No pun intended, that session is probably going to be out of this world. So have a great rest of your day, everyone, and we will catch you at the next Experience Rochester event. Take care.